The one thing no one ever talks about when buying a house is how much interest you actually pay, especially in the beginning. So let's just, for instance, take a $400,000 house and we'll do it at 6.75 interest, roughly 6.75. You will pay at 400,000, you'll have 400,000 in principal and about 500, a little less than 550, I believe. Let me look at my exact numbers. At 6.75, the total interest paid would be $534,200 over 30 years. So after everything's said and done, you're paying $934,200. So when you buy a $400,000 house, if you lived in there for 30 years, you're paying $900,000 to own that house. And this is where everything changes, right? So someone could be like, I bought my house for $400,000, let's say 30 years ago, and I sold it for $1 million. I made $600,000. Well, did you really make $600,000, or did you only make really $60,000 or $70,000? Because of all that interest that you paid over that 30 years, right? So at the end of the day, in the beginning of a mortgage, right, in the first couple of years, let's just say, for instance, you have $10 and it's a $10 mortgage payment. Like nine of those dollars are going straight towards the interest, and one of those dollars is going towards principal. Now, unless the market goes up and you build equity by an increasing appreciative market, so like if you bought the house for $400,000 and within a year it's worth $500,000, which is not going to happen, but I'm just using an example. You're not building equity when you're paying a mortgage payment right away, because most of it is going towards interest. And this is why I hate when people say buying's better than renting. Buying's better. It's the same thing in the beginning, right? You're paying interest to a bank, which is like the landlord, or you're paying your landlord. Because unless the value appreciates, what's the difference? I know people right now that have bought 2 years ago and cannot sell their home right now. Right? They can't, because the market didn't go up, and with closing costs and everything else, they'd be underwater. The video for another day. I know I'm getting off topic here, because it drives me crazy that people really don't understand. Like, when you buy a house, the bank wants their money first. So you look at a 30-year amortization rate at $400,000 at 6.75. Total payments of 30 years, 360 payments of $2,595. What you borrow, the principal will be $400,000. The total interest will be $534,200, with a total percentage of payments 57.2. That's crazy, right? So that's what people don't realize. So the first year, the annual interest paid would be $26,000. What happens is when you buy a house, the bank wants their money and they want their interest first. So if you bought a house, again, ready? Watch how this works. If you bought a house for $400,000, okay, your remaining balance the first year would be $395,724, with $4,276 going towards principal and $26,864 going towards interest. That's what I mean. So for the first year, $4,276 went to the principal. You made no money. You can't sell your house, right? Second year, the same thing, about $4,566. Third year, $4,876. And then after year 10 or 15, more of it is going towards principal, a lot more. This is what people need to understand about real estate. When you buy a house and you're paying a mortgage, you can't be like, oh, I paid $5,000 a month, so at the end of the year, $50,000 must go towards principal, and I have all this equity. It does not work that way. Just keep following me. I'm going to put everything in the YouTube thing. I put everything, the links to read everything. I just do these short videos for you guys so you understand, because I want you to be like, oh, what do you mean? So you mean when I buy a house, my mortgage payment doesn't go towards the principal? Well, a little bit does. Just a little bit. The majority goes towards the interest. So you're not building, or like, I'll give you a perfect example. This is a really good example. Let's say you had a $400,000 credit card bill, and every month you paid $2,595 towards the credit card bill. But what they did is at the end of the year, they only took $4,276, which is literally less than 2 months So less than 2 months of your payments, they actually put towards the principal. The rest of it, they put towards interest. So then all of a sudden you're like, okay, so after 5 years of paying that $400,000 credit card, you still owe $375,000. Huh? Wait a minute. Wait, what do you mean? By year 7, what do I owe? $364,000. That's what I'm saying. They're paying all that money towards interest rates. Now, you can do certain things like, putting more money towards principal. You can allocate money towards principal. Yeah, absolutely. You can do that. And I'll do a separate video on how to do all that. But remember, these are things you need to know and understand, because this is what I'm here for. And if you guys have any questions, please let me know. And you can also check out my new thing. It's called the Realtor Review, where we do different reviews on clones and different things, because we want to smell good and look good and whatnot. So it's not all just about education. I just launched that the other day, and I'm excited for it. So if you have any questions, let me know. I will talk to you guys soon, and keep following me for all your real estate education.